with chaos at the New York Stock Exchange.
Get back in there at once and sell, sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer of BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday the 13th. Ooh, Friday, June 13th, 2025. Welcome to the end of the week. Some shout outs to Bill, Marsha, Bub, Jody, Bob, Diane. So many folks tune in week in, week out. We appreciate it. Glad you're getting some value out of the program. So, hey, what is going on with the markets? Well, they're down. Not too much of a surprise. We kind of thought the market was kind of stretched anyway, so we've been looking for a pullback. We'll talk about the reasons here for just a moment, but Dow Jones is down 1.3% on the week, back to negative on the year, down almost 1% on the year. The S&P 500 down 0.4% on the week. The NASDAQ Composite down 0.6%, and the Russell Small Cap Index down 1.4%. So all the major indices drifting a little bit lower this week. And as you might expect, the volatility index bouncing up quite a bit, up 24% this week, up to a 20.8 on the VIX. So I think I can go a little higher. We'll see how that shakes out. What I don't like are the bonds. Now, bonds did do a little better for the week. They're up 1.1% on the week, TLT was, which is good because they just haven't had the traction I'd like to see. But I think a lot of the reason why they did well this week is because of the inflation numbers. We had a really good CPI, Consumer Price Index, and a good PPI, Producer Price Index. So both retail and wholesale numbers were better than expected. I think the market responded positively to that. So rates came in a little bit, came down a little bit, bonds went up. But what I didn't like, beyond not like, what I hated to see was the action today here on Friday. You know, look, I'm sure you've heard the news. Israel has attacked Iran in a major offensive. It's not lobbing a missile here or there. It was a really major move they made and caused the markets to go down quite a bit today. I mean, all of them were down over 1% today. But what shocked me was how poorly bonds performed today. I've said for many years that America's okay as long as everybody runs to the dollar when they're afraid. As long as everyone runs to the United States when they're scared, then we're in really good position. And we've got time to work things out. But I've got to tell you, I don't like seeing the action in the bond market today. The bonds were down. TLT was down 1% today, along with the market down 1%. That's not what you want to see. Now, the dollar was up a little bit, but that was even up a whole lot, up 0.2%. It seemed like the real safety trade was gold. Gold was up 1.3% on the day, and it was up 3.6% on the week. Silver up 0.8% on the week. And we look at all the other sectors, the big performers were energy. A lot of it happened today, up 5.6% on the week. And other than that, technology up 0.3, semiconductors up 1.6. Everything else was just kind of down, flat to down. Financials are down 2.5, but the big mover was energy, up 5.6% this week. So what's moving markets? Well, we've had some good things coming into the week. They have the China and U.S. delegations meeting in London to discuss trade negotiations. The reports out of those meetings were positive. The market responded in kind. We had good CPI and PPI, and that's important because everyone's been anticipating a huge spike in inflation due to tariffs. I think that could still be on the way. See, look, there's been a tremendous amount of front running the tariffs. We talked about that much earlier in the year. Can you believe we're over halfway through the year already? But anyway, way back in February, March, we talked extensively about this. There was a tremendous amount of front-running tariffs. It caused a historic trade imbalance. It also caused a negative GDP for the first quarter. Now we're actually seeing some preliminary reports of a really huge GDP for the second quarter because all that front running is now showing up in inventory as assets. So by buying all this stuff ahead of time, ahead of the tariffs kicking in, companies have had the ability to kind of manage this pricing and not have it just spike straight up. So, and of course, there's been the delay as well. So all of those things are factors. I'm not saying that the inflation isn't coming. I think that it's still likely to show up or probably later in the year. And I think it'll be kind of that one and done type of scenario. You'll see that spike and then it should settle down. It's not a continuous thing. It's not like the inflation we were seeing in 2022 where everything was just spiraling out of control, escalating every week. I had clients in the construction industry. They were buying conduit for like electric lines one day and then pricing the job out. And then a week later, it was up 20%. So they all had to build in price adjustments to their contracts. It was just a mess. The tariffs won't be like that. They'll hit and then they should settle. So we'll see how that plays out. But I guess my point is this. The economic data this week has been decent. Market was responding in kind. And of course, the Israel-Iran flare-up caused the markets to go off the rails here today on Friday. That said, I will say this. I'm really surprised they didn't end worse today. I mean, I thought it would be an uglier day on the market. The S&P was only down 1.1% on the day. I kind of expected it to be worse than that, but it held in pretty well. One of the reasons is because the targets have been very specific. They've stayed away from Iran's oil production. Now, if Iran responds, if things escalate, which, look, I think they probably will respond if they can, if they're able to. I think there will probably be some sort of response. We'll have to see how all this plays out. But if Israel stays away from their oil production, then prices probably won't go up a whole heck of a lot more. I was doing some research on that, looking at some things regarding historic conflicts and how oil prices have been impacted. When you go back and let's go back to like 1948. That's the data that I was looking at earlier today. The average increase is about 17% in energy when something flares up in the Middle East. It takes about 2.5 months for prices to peak, and then they settle back down. But if you go back to 1948, that includes the Yom Kippur War in 1973, and that was a 135% spike in energy prices. You might remember the lines, the gas lines, and all those types of things at the time. So if you take that out, if you take out the Yom Kippur War, then the spikes really aren't quite as bad. They tend to be quite a bit more muted, anywhere from 2% spikes up to maybe 32% with the Gulf War in 1990. And look, the market tends to react to geopolitical events pretty quickly and then settle back down pretty quickly. So it tends to look past it, doesn't seem to hang on to it for very long. We saw the Russia-Ukraine war, and we've seen it with other conflicts throughout history. So I think there's probably still some more pain based off the technicals. So you remember last week, I mentioned that the market looked like it was stretched. We got 9s and 13s on the DeMark countdowns. These are just technicals that kind of give me an idea where the move has been exhausted, whether that move is to the upside or the downside. When we get these DeMark counts, it kind of indicates some exhaustion. There's other technical indicators that were pointing to the market maybe wanting to roll over and pull back here for a bit. And you say, well, David, that just seems hogwash to me. How could you know that Israel's going to attack Iran and send the market down today? Well, I don't know. But look, the market looks for the reason. Sometimes it looks like really coincidental. You go back to 2020. We had a big 9 and 13 counts in the DeMark indicators. We had all kinds of indicators saying the market was stretched early 2020. And then COVID hit, and of course, you had this really gigantic move lower. And say, well, it was COVID, it was a coincidence. Yeah, but look, there's multiple times throughout history where we get these exhausted trends in the market, and the market sells off, and it'll find a reason, right? Someone can trip and stump their toe and make headlines, and the market will take it as a reason to sell off. You don't know what it's going to latch onto. Sometimes it's given something obvious, like today with Israel and Iran. Sometimes the market has to look a little bit harder for a reason, but it'll find it when it wants to sell off, when investors want to take profits. They'll find the reason, they'll pull the trigger. So I think that this can last a little while longer. Today's move lower, I think that could kind of set us up for the market to kind of drift a little bit lower over the coming weeks. I don't expect anything really major. And I think that 5,800, that 200-day moving average, is that first strong line in the sand of support there. And the market might work its way down there and stop. So look, I did a little bit of buying today in the morning. on the pullbacks, all the oil stocks and anything related to energy kind of jumped up. And this stuff's been lagging for a bit. I was getting ready to buy more of this stuff within days, and the market forced me to kind of move a little bit faster. So this morning, everything spiked up big on the open, and then it pulled back quite a bit mid-morning. And I took that as an opportunity to add a little bit more money to Schlumberger. That's oil drilling services here in the U.S., well, actually all over the world. But with our current administration being so pro-energy, I think that's a good place to have some extra exposure. So I did that. And for folks that have had new money come in, I put some of your money to work today. Not a lot. I think the market goes lower. So there's a lot of things that we did not buy today, but we'll be looking to do so in the next couple of weeks if things drift lower. And I think that they probably will. The technical indicators suggest that they will. Now we've got a geopolitical reason to sink our teeth into. So I think that the probabilities are pretty high. We'll pull back a little bit. As I've mentioned the last couple of weeks, when you look at everything that's happened since the lows in April, I think it's highly unlikely, highly improbable that we're going to go back down to those lows. I think the worst is likely behind us. And this move that we're getting right now will likely be probably one of the better buying opportunities you're going to get for the rest of the year. So we'll be looking to kind of step in and do a little bit more buying if the opportunity arises, get all the new money that's come in. We've been sitting on it here for a couple of weeks, waiting for a step back. So all you new clients, all you folks that have deposited new money into your accounts here in just the last couple of weeks, we haven't done anything yet. We're doing it now, and we'll get that money worked in as the market drifts a little bit lower. So that's what I've got for you. Nothing to get too alarmed about. We'll continue to watch it real close and make moves as necessary. But hey, right now, it's kind of doing what it always does when these things happen. Of course, it sold off a little bit towards the end of the day here in preparation for what the unknowns that might take place over the weekend. But I think we're in pretty good shape where we sit. So I'm going to go and wrap up. Between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early. Take that safari to Africa. I got a client that did that. Done it a couple times, actually. Loved it. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.